So we're starting. Are you guys ready?
Sure, we are ready.
Okay, great. So I'll go ahead and share my screen right now.
Yeah, we're fully ready.
So in the last webinar, I introduced you guys to technical analysis and fundamental analysis, and we went ahead and talked and we discussed the differences between technical analysis and fundamental analysis. I will talk of the steps you have to take if you want to trade using technical analysis. And after that, we went and talked about the financial charts, and we started with the basics. Then we talked about the chart basics. We elementary from our elementary knowledge, we know that the y-axis is at the left-hand side and the x-axis at the bottom. And we see that all charts follow this simple pattern with simple variation. And for financial charts, we see that the y-axis is taken to the right. We have the ticker at the top left corner, and of course the x-axis still remains where it is, and the y-axis becomes price, and the x-axis becomes the time, either in minutes or hours or week or whatever, depending on what you choose. And we looked at a basic or a typical financial chart setup. We see that ticker is here, up here. This is the price, and here we have the time. And the beautiful thing we see here is how the price is moving. And we see there are basically three types of financial charts. We have the line chart, the bar chart, and the candlestick charts. And we see the line charts. The beautiful thing about the line chart is that it shows all the price at every point in time, but it is not really good, and it doesn't really give us enough information when we want to trade, when we are trading. Therefore, we prefer to use either the bar charts or the candlestick charts. Or we also talked about the bar charts, and we talked about the highlights, which is the high, the low, the open, and the closing prices. Then we'll move on to the candlestick charts, which I said is the most used chart in trading financial markets. And we went and delved straight into it. We talked about the history of the candlestick charts, the element of the candlestick charts, and we were in types of candlestick charts. So I believe we all understand the basics. If when a candlestick is bullish and when a candlestick is bearish, the anatomy of the candlestick chart, the anatomy of the candlestick chart, which is the body, the wick, the closing price, the open price, when the candlestick is green, when the candlestick is red, and we also see that a green candlestick can also be represented by white, while the red can also be black. Then we talked about candlestick patterns and time frame, and we say that candlesticks are fractal. In other words, a 60-minute candlestick chart can be broken down into two 30-minute candlestick or 4 15-minute candlestick. Then to further help us understand more about candlestick pattern, we talked about the bulls and the bears. And we say that we should see the bulls as the buyers, that when the bulls are active, that is when there is a lot of buying activities in the market, the price is going to rise. It is natural that when a lot of people are buying a particular thing, the price of that thing is going to rise. When the demand for something is so high, the price is going to rise. So we see the bulls as the buyers, and when they're very active, the price is going to rise. And we see the bears as the sellers. when a lot of people are selling, the price is gonna fall. I would still see the financial market as a constant fight between the bulls and the bears. When the bulls are in control, it means that a lot of buying activity is taking place, and because of that, the price is going to rise. And when the bears are in control, it means that a lot of selling activity is taking place, and because of that, the price is going to fall. So the price can be rising or falling or consolidating. When we say it's consolidating, it means that neither the bulls or the bears are in control. They are more like resting to reload and get back to the fight. Then from there, we talked about the candlestick body itself. We say a candlestick with a large body, like this red large body and this green large body, shows that there's a lot of selling and buying activity in that time frame. Then if we see a candlestick with a small body, it means that there's really not much buying and selling activity taking place. Then we also talked about the candlestick with long tail or long shadow or long wick, whichever term you want to use in describing it, and what they are telling us. In other words, I'm saying that when we look at the candlestick, we should try to decipher the story that the candlestick is trying to tell us, or the market psychology depicted in that candlestick. And we went ahead and talked about different types of candlestick pattern, the story they tell, and how we're going to use them. And we went ahead and talked about the bullish candlestick pattern, the engulfing candlestick pattern rather, and we'll see there are two of them, the bullish engulfing and the bearish engulfing. Then we'll talk about the Doji candlestick pattern, the Dragonfly candlestick pattern, the Gravestone Doji, the Pin Bar. We stopped at Gravestone Doji. So today we're going to talk about the Pin Bars, the bullish and the bearish, the Harami pattern, the bullish and the bearish, the Tweezer top and Tweezer bottom, also bullish and the bearish, the morning star and the evening star. And this is where we're going to end this class for today, although I'm going to give a summary of it all. But before we start with the Pin Bar, I think I should go ahead and just refresh my memory with the engulfing, with the four we have already talked about. That is the engulfing to the Gravestone Doji. Someone is on. Can you mute your mic if you are not? Yeah, okay, good. How do I mute people? I need to mute everybody. Okay, mute all. So I have actually muted everyone. So let's continue. So back to the when we talk about the engulfing candlestick pattern, we say that the second candle, the idea is the second candle is engulfing the first candle. It is bullish engulfing if the second candle is green and the first candle is red. It is bearish engulfing if the second candle is red and the first candle is green. When it's bullish engulfing, we are expecting the price to rise, especially if this candlestick pattern occurs at the bottom of a downtrend or a key support area. When it is bearish engulfing, we're expecting the market to fall or to take a downward trend, especially if this occurs at the top of an uptrend or a key resistance area. So for the bullish engulfing, we looked at example of a chart that, see, this chart is in a downtrend, then this bullish engulfing occurs here, and what happens is that this market changes direction to the uptrend. Also, for the bearish engulfing, it's called bearish engulfing because we expect the price to fall when we see it, especially if it occurs at the top of an uptrend. And so the example here is that we see this trend going up, then we see this candle, this candle, this candle. They are all bearish engulfing candle. and what we notice is the market crashed. All right, and you can also see here that this is bullish engulfing, and the market start rising again. So that is that for the bullish and the bearish engulfing candlestick pattern. The next candlestick pattern we'll talk about is the Doji candlestick pattern. The market, when we see this, we are saying that there's an indecision in the market. The opening price is same thing or close to the closing price. So the market is not decided on what to do. So we'll say there's indecision here. And if this occurs at the top of an uptrend or a key resistance area, it means that the trend is expected to change to the downward direction. If it occurs at the bottom of a downtrend or a key support area, it means that the market is going to change to an upward direction. Now you're going to hear me talk about, say, key support area, key resistance area, uptrend, top of an uptrend, bottom of a downtrend a lot. And this will be the basics for our next webinar. In the next webinar, I'm going to really decipher this, show you how to draw, to locate a support area, a key support area, a key resistance area, because these are very key to trading using these candlestick patterns. So back to the Doji candlestick pattern. So this one is occurring at a key support area, and what happened is that the direction changes to the upward direction. So it's a good entry period. It's a good entry point. And if you remember what I said about entry, do not just trade the candlestick patterns alone. Try to confirm or find confluence using other indicators. Finding confluence is when you use more than one indicators and they are saying the same thing, and then you are sure, okay, yeah, I am more sure that this is likely going to happen. Then this example of a doji occurring at the top of an uptrend, what happened is, or a key resistance area, and what happened is that the trend changes and starts going in the other direction. The next one is a Dragonfly Doji. Like I said, the Doji has two other variations, the Dragonfly and the Gravestone Doji. And the Dragonfly Doji is like this. We have more of the buying and selling activity occurring at the upper side of this candlestick. So the anatomy is that it has a very long shadow and a little or no upper shadow. The market psychology here, or the story that it's telling, is that at the beginning of this time frame, or this time of this period, the bears drove down this price to this point, but the bull says no, and they fought and brought this price back to almost or at the opening price, which means that the bulls actually won this fight because they overpowered the bears and took this price up, and because of this, we are expecting the price to continue rising in the next period. So when this happens, when Dragonfly, where we should be looking out for Dragonfly is at the bottom of a downtrend, because if it occurs there, we should expect the price to change. We should expect the market to change direction to the upward direction. So looking at it here, you see this is a downward direction. We see a Dragonfly here, and what happens is the market change course, and you see it started rising sharply. So the Gravestone Doji is opposite of the Dragonfly. It's just inverted. It has a long upper shadow and a little lower shadow, or sometimes no lower shadow. The psychology is also the reverse of the Dragonfly. It means that at this period, this opening price, the bulls came, took the price up, and the bears overpowered them, brought the price down to back to the closing price. So it means that for this, that the bears are winning. Therefore, if it occurs at the top of an uptrend, we should expect the market to change course to the downtrend. Let's look at the chart. So for the chart, You see the market went up, and what do we see here? A Gravestone Doji, and what the next thing, the market started going the other direction. So that said, and that is where we stopped the last time we had this webinar. So for today, we're going to be looking at, we're starting with the pin bar. The market psychology for all these are barely just the same in a way, because it's always a fight between the bears and the bulls. So the pin bar is a powerful candlestick pattern. The candlestick has a small body, a long tail at one end, and a short tail at the other end. The long tail must be at least 2 times the length of the body. This tail you see here, for it to become a pin bar, must be at least 2 times the length of this body. This candlestick pattern occurs quite often, and I like trading this particular candlestick and pattern. There are 2 types of it. We have the bearish, the bearish pin bar. This one is the bearish pin bar, and which is called the shooting star. And we have the bullish pin bar, which is this one. It's also called the hammer. So let's start with hammer. You can see the different version of the hammer. It can have a small upper shadow or no upper shadow. The color here doesn't matter. It can be green, it can be red. So the hammer, the story the hammer tells is that the same thing. The bears came, took the price down, the bulls overpowered them, took the price up to end that period. It means that also that the bulls are in control of the market. When you see the hammer, it's telling you that the bulls are taking over. And if the bulls are taking over, it means that that price is going to rise. So if we see this hammer at the bottom of a downtrend, we should expect the price to change. We should expect the market to change course and go to the upward direction. If we see it along an uptrend,
Jesus. This boy is stupidness.
Okay, let's continue. So if we see this, if we see the hammer along an uptrend, we should expect the market to continue in that direction. It's also a strong entry point for us. So looking at the charts, this is a downtrend. So the market came down here, and this hammer occurs here. And when the hammer occurs, what happened? The market changes and starts change direction and start going up. And this is still in the uptrend. This we still see the hammer here, which shows that it's another opportunity for us to enter this market, and you see the market continue in the upward direction. So another thing is the color of the hammer does not really matter, but a green hammer is stronger than a red hammer. The next one is the bearish pin bar, which we call the shooting star. It is just the opposite of the hammer. It tells us opposite of what the hammer is telling us. It tells us here that the bears are in control. So if you look at the market psychology again, or the story is telling us that at the opening price, the bulls took the price up and the bears took the price down before that period ends, showing that the bears are overpowering the bulls. The sellers are overpowering the buyers. And because this happened, we should expect the price to keep going down, especially if it occurs at the top of an uptrend or a key resistance area. And if it occurs along a downtrend, we should expect the market to keep going down. So if we look at another chart, look at this chart, the hammer occurs here, which is a key resistance area. After some period, the market started going down, and when the market climbed up again, it occurs here, and what happened? The market went down. So it's a good point. When we see this hammer, it's a good point for us to actually sell if you are trading sports, and it's a good opportunity for us to short if you are trading futures. Again, you are not meant to trade the signal given by the shooting star alone. You should always try to find confluence that is confirming the signal you get with other key indicators. The next one is the Harami, or what we call the inside bar. This candlestick pattern is considered to be a reversal or a continuation candlestick pattern. You see, all the candlestick patterns we're talking about, they are all reversal or continuation. It consists of two candlesticks. The first one is a large candlestick called the mother candle, and the second one is a small candle called the baby candle. For the Harami pattern to be valid, the second candle must close inside the first candle. This is more like the other way. If you look at, if you flip the bullish engulfing, if you flip the engulfing candlestick pattern, I think you get the Harami. So this one, the second candle, which is this, must close inside this one like this. It mustn't be outside the first one. The same thing with this. So there are also two types of it. You have the bearish Harami and the bullish Harami candlestick pattern. Let's look at the bullish Harami. So for the bullish Harami, you have the first candle is a large red candle, showing that the bulls are in control. The next one is a small bullish candle, showing that the bulls are gathering momentum to take over. So remember what we always say. I don't know who draws this. I don't know how it happens. Remember what we always say. When you hear bullish, it means that the price is going to change to the upward direction, and we should expect it to occur at the bottom of the downtrend or a key support area. When you hear bearish candlestick pattern, we should expect it to occur. We should expect that the signal is strong when it occurs at the top of an uptrend, and therefore the direction is going to change. So still on the bullish Harami, we have a red candle and a small candle here. So if you look at the chart here for the bullish Harami candlestick pattern, this is a downtrend. The market is trending down. Then what happened here? This is the bullish Harami, and once it occurs, you have this and this, and after it occurs, the market changes course and started going the other direction. For the bearish Harami, the same thing. You can see the mother candle and the baby candle. Well, like I said, when we hear bearish, we should expect it to be a strong signal if it occurs at the top of an uptrend. And when it occurs, we should expect the market to reverse and take the downward direction. So if you look at this, it tells us that, okay, look at this, the market is trending up, and what happened? We see a bearish Harami, and after that, the market crashed. Let me go back and show you something. So if we see the bearish Harami candlestick pattern, it's a strong indication that we can enter this trade. So if we enter this trade, we should expect this, which is a good entry for us. It's a good entry signal for us to enter this trade. If you look at here, it's telling us to leave this market if we are trading sports, or short this market if we are trading futures. But like I said as well, find confluence before trading with this candlestick signal. The next one is the Tweezer top and the Tweezer bottom. The Tweezer top and the Tweezer bottom. The Tweezer bottom is also called the Bullish Tweezer because it's occurring at the bottom, The Tweezer top is also called the bearish Tweezer because it's occurring at the top. So the Tweezer candlestick pattern are made up of two candlesticks, two large real body candlestick pattern of different colors. So let's look at the Tweezer top, which is the bearish Tweezer. Bearish, like I said, if you hear a candlestick pattern, you hear bearish with it, we should be expecting it to occur at the top of an uptrend, and thus the direction should be changed. So the first candle for the bearish Tweezer is a green candle followed by a red candle of large real body of equal or approximate size. If you look at the two candles forming the Tweezer top, you will see that when combined, if you combine these two candles, like I said, that the candlestick pattern and time, when I talk about the candlestick pattern and time frame, that the candlestick patterns are fractal. You can break them down into smaller sizes. So you can also join them into bigger sizes. So if you join these two candlestick patterns, you combine them, you will get a Gravestone Doji. And because you get a Gravestone Doji when you join them, it should tell you that it should have the same characteristics of a Gravestone Doji. That is, it occurs at the top of an uptrend or a key resistance area. We should expect the market to change direction, to change course, and go down. Let's look at an example. So this is a market trending up, and we have a Tweezer to the top occurring at the top of an uptrend. And what happens is that after it occurs, the market change course and start going in the downward direction. So if I'm holding a bag, it means that I should sell it here. If I'm trading futures, it's telling me, okay, it's time for you to short. The next one is the Tweezer Bottom, or the Bullish Tweezer. So the same thing, if you combine the Tweezer top and the Tweezer bottom, you will get the Dragonfly Doji, which is opposite of the Gravestone Doji. It means that for this case, it shows that it's following the same characteristics. And from what we learned from the Dragonfly Doji, it's telling us that in this case, the bulls are in control. Therefore, if you find this at the bottom of a downtrend, it means that the market is going to change direction because the bulls are taking over and go in the upward direction. I don't know whose mic is on, but let me try to mute again. Okay, great. So the same thing, this is a sample for the Tweezer bottom. So the market is trending down, and we have a Tweezer here. And after the Tweezer, what happens? The market changes course and start going up. So it's a strong entry for us if we are trading sports, and a good signal for us to take a long position if you're trading futures. So let's go to the last two, which is the morning star and the evening star. Now the morning star is made of 3 candle. The morning star is considered a strong bullish reversal candlestick pattern, especially if it occurs at the bottom of a downtrend. It consists of 3 candlestick patterns. The first candlestick is a bearish candlestick pattern with a large real body, showing that the bears are in control of the market. The next candlestick is a candlestick with a short or small body, showing that the bears are losing control of the market. This candlestick, this small one, can be a green or a red candle. And the next, or the third candlestick pattern is a bullish candlestick pattern, showing that the bulls are taking control. For this morning star to be valid, this bullish candlestick pattern must be that. For this candlestick pattern to be valid, it means that the third candle, which is the bullish candle, must be at least half of this first candle. It can be half, it can be more than half, but it should be at least half of the first candlestick pattern. So let's look at the charts where this occurs. So you can see a downtrend, then we see a formation of a morning star. So we see the bullish candle, this small candle showing that the bulls are losing power. This one shows that this is a bearish candle. Bearish candle. This small one shows that the bears are losing power. The green one shows that the bulls are taking over, and what happens? The trend changes. So this is also a strong entry point if you're trading sports, and a good position for you to take long, for you to take a long position if you're trading futures. The next one, the last but not the least in our list is the evening star. The evening star is also a reversal of the. So we're like doing what an opposite, this and the opposite. So the evening star is a reverse of the opposite of the morning star. It is considered a strong bearish reversal candlestick pattern, especially if it occurs at the top of an uptrend. It consists of 3 candles. So I'm muting everyone now, and I'm not going to allow anyone to unmute. Okay, good. So nobody can be able to unmute themselves now. So it consists of 3 candles as well. First one is the bullish candle, saying that the bulls are in control of this market. The next one is another small candle. It can be a red candle or a green candle, showing that these bulls that are taking the market here are losing their control. And the last one is a bearish candle, saying that the bears are taking control. And like I said, for the morning star, this third candle must be at least half of the bullish candlestick pattern for this candlestick to be considered to be valid. So if this candlestick pattern occurs at the top of an uptrend or a key resistant area, we should expect this market to change course and start falling. So this is the evening star. This is a market. This is a candlestick. This is a chart, and this area is actually a key resistant area. And you can see the evening star form here. You see a bullish candlestick pattern with a good real body, and this one with a small body here, and the next one is a bearish candlestick pattern. And what happened? The market drops. So it's a good point for us to sell our bag if you're holding a bag when we're trading spots, and a good point for us to short the market if we're trading futures. So this brings us to the end of the collection of the candlestick pattern that I've selected. And I did a table to show us the summary of what these are. So we have, I listed the candlestick patterns, places of occurrence, and the signal. The place of occurrence is, we're expecting it, we're not expecting this candlestick to, before we can take this pattern seriously, we should expect it to occur at a certain area. If it just occurs anywhere, we shouldn't take it serious. We should only take it serious if it occurs at some certain areas, either at the top or at the bottom, mostly. All right. There are some maybe I should have included where it occurs, the ones that occurs along the trend. But let's just go with occurring at the top and occurring at the bottom. So for this first section, the place of occurrence is at the top. So what candlestick should we expect at the top? They are the bearish engulfing. Again, what candlesticks should we expect at the top for we to take them serious? We should expect the bearish engulfing, the doji, the Gravestone Doji, the shooting star, the bearish Harami, the Tweezer top, and the evening star. So when they occurs at the top of an uptrend or a key resistance area, then the signal it's giving us is that we should exit our position or take profits if we are trading spots, or we should short sell when we are trading futures. The second part is if it occurs at the bottom of a downtrend or a key resistance or a key support area. That is, what we should expect here should be the bullish engulfing, the doji, the Dragonfly Doji, the morning star, the hammer, the Tweezer bottom. This is a mistake. I have morning star twice here. This one is meant to be what is it meant to be? I think I'm missing one here. Doji, Gravestone, Dragonfly. Okay, yeah. So the bullish Harami is what I'm meant to put here, not the morning star, because I've already put morning star here. So the bullish Harami is what is meant to be here. So I'm going to correct it after this. So if it occurs at the bottom of a downtrend, this candlestick patterns, then the signal it's giving us is that we should enter the position. It's a good place for us to enter position or for us to buy when trading, or take a long position when trading futures. So if we're trading spots, is these ones are telling us to buy, these ones are telling us to sell. If we're trading futures, these ones are telling us take long position, this one are telling us short sell. In conclusion or in summary, the candlestick patterns I listed above are not all the candlestick patterns there are, but these are the most important ones. It is not important that you know the names of all these candlestick patterns. What is more important is that you know the story they tell, the market psychology, and the signal they give you, and where they should occur. 3, you must not trade all these candlestick patterns. You can just master 2 or 3 of them. Mastering 2 or 3 of them and where they occur and where you should take them seriously, it's enough for you to carry out successful trading career. 4 is that always find confluence. Do not trade this candlestick pattern alone. Find confluence with other indicators before trading the candlestick. Now, I'm going to talk about finding confluence, of course, in the course. In the course itself, talk about using other indicators to find confluence to say, okay, this we should really take this trade. So this brings us to the end of this webinar. We started at 9:15, and so it's about we took about 45 minutes. And the next webinar, which we're going to hold next week, we'll talk about the support and resistance and market structure. So I hope you enjoyed this webinar so far, and I hope things are clear. If they're not clear, I'll be open to take your questions now. So let me go ahead and unmute the mic so I can take questions. Okay. So if you have any questions, you can unmute your mic now and ask me the question. While you're doing that, I'll go ahead and start answering chats because I have 8 messages in the chat. Yes, I'm making a recording, so I will share the recording soon. I'll upload the recording on YouTube with the link.
Hello, good evening.
Yeah, good evening. Who is speaking?
Very much. This is Samuel Ayogo.
Okay,
Thank
Samuel.
you very much. I've been following the class. I actually started joining late, but I'm glad I picked up one of few things. My question, basically, I don't want to do. I'm glad I shortened the summary, the candlestick patterns. So I'm just like I'm actually those ones I use. But what I want to, you just talked about the confluence between the candlestick pattern and trading with the candlestick pattern and other indicators. So I was wondering when we are going to, is there any particular indicator that, first of all, I want to know, is there any particular indicator that you feel is more superior to the other, like trading pattern, any other indicator? Okay. Then secondly, I was wondering if there was, if you are going to, we are going to have any session where you talk about the complex and probably talk about other indicators you use in reaching your resolution trading. Thank you very much.
Okay. To answer your first question, if there's any preference to indicators, different traders find what works for them. So there's no really a particular standard. Some traders find confluence using trend lines with this. So traders find confluence using trend lines with the signal the candlestick pattern is showing. Some find confluence using RSI. Some find confluence using MACD with the signal is giving. Some find confluence using moving average. Some people just trade with say MACD. No, not MACD. Some trade with moving average. The support areas, they draw support areas and the candlestick pattern. So they trade with what? The moving average, the support area, and the support or resistance area, the key support or resistance area, and the candles and the signal, the candlestick pattern. So if you trade with these three, you have already found, and they give you the same signal, it means that you have found confluence. You can also use MACD or RSI or stochastic oscillator, and there's so many of them. There's not really one. The one you try out and find, you don't have to know all the indicators. If you just know 2 or 3 of them, even 2 of them with your candlestick pattern is enough for you to carry out a successful trade. And if there's going to be another webinar to show for this conference, not really, because it's going to be included in the City Mastery course, the volume 2 of the City Mastery course. What is out there is volume 1, and this webinar is actually more like an introduction into what it's like a tip of the iceberg to what you're going to find in the volume 2 of the City Mastery course. What we're going to do in the next webinar is we're going to treat support and resistance, just trying to get you to understand the market psychology. We're going to talk on support and resistance and the market structure. I feel that for you to really understand what I'm saying, I'm talking about key support, key resistance area, key support area, top of the uptrend, bottom of the downtrend. I feel that I will not do justice if I did not also hold a webinar talking about the support and resistance and the market structure. So I believe I've answered your question, Samuel.
Thank you very much. That was very wonderful. Thank you very much.
So do we have another question?
Hello.
Yes.
Yes. Hello, Mr. Jude.
Yes, who's on the line?
This is Christian. Chris.
Christian.
Chris.
Yes. I must really apologize to you. I've actually that question you asked me, I said we're going to meet on Monday. I've actually attended to that, just I've not communicated with you. All right. So let's have a call. Yeah. Today is Friday. Let's have a call tomorrow. Just give me a call on Telegram and we'll talk.
Okay.
So go ahead and ask your question, please.
Yeah, the other time is when we were taking us on this fundamental, we get to technical analysis. You made mention of a fundamental signal group.
Yes.
Right.
Yes.
Hello. Yes. And then opinion pool sampled, from the platform showed that so many are interested, at least about or more than that. But the problem is that we don't have we don't have somebody that can coordinate us and then tell us the next line of action to take, because a good number of us are really interested in it.
Okay. What's going to happen is that I'll have Francis create a group in Telegram, and those are interested in that particular group are going to join. Then I'll not contact the I'll not from there. I'll know the number of persons are interested and how to move them to that particular fundamental analysis signal group.
Okay. Thank you very much.
Good evening.
Thanks.
Yeah, good evening.
Am I going
Yeah, Leonard Azubike.
Hello,
Okay.
Jude. Hello, Jude.
Please, I think Azubike
I'm really
is
enjoying
talking.
today's
Are you through with question and answers? Can I go ahead with the question?
Yeah, Azubike is asking.
Christian is talking.
Hello, this is Azubike on the line, please.
Okay, Azubike, go ahead.
Okay, this is my first time of joining the class. I've been in contact with Francis all this while. He has been helping a lot. Okay, I'm sure I enjoyed the class, but I want to find out one or two things more. You understand? Though I've been trading forex, but not crypto. I want to find often when you guys normally have this seminar. This once in a week or monthly.
Well, we have a trading course, an academy you can just enroll and learn things from. All right. Now we've held this. This is the second time we're holding this, and we're holding another one next week. Then after next week, we are meant to launch the course, and the next one we'll hold the next one. I don't know, but after the next one, we can now decide on when to hold the one after that. But I will encourage you to just go ahead and enroll for the City Mastery course.
Yeah, sure. That will do that one this week. Okay. All right. Thank you very much.
Hello, Jude. This is Tariq. I wanted to ask a question now.
Go ahead, please.
Can I go ahead?
Yes, please.
Okay. First of all, thanks for the class. It's really a wonderful class. I really enjoyed it. The question is for the volume 2. I wanted to find out if it would be inclusive of the margin trade.
Okay, the thing is, I don't want to make it so. Atara, are you with me?
It's muted.
Okay, for the volume 2, what I want to do is I just want to base it on sports first. Then after that, I'm going to do a bonus class, which is going to be on futures, because what you're going to learn on this technical analysis, futures is just like application of saying, okay,
Trading on Bina, draw key support areas, because now you're using your app and you don't know what areas are.
Hello? Sorry. Okay, I didn't get all the question you asked. I'm sorry, but let me try to answer what I got. You're asking if the volume 2 is going to include, if it's going to include futures and margin trading. So what I'm saying is, I don't want to, yes, it's going to be included in the course, but not particularly in the volume 2. So this volume 2 is going to be basically on sports. Then I will do a separate bonus class or module that will talk about how to apply what you learn in sports, in trading, futures and margin. The idea on trading futures and margin is more like you should master your money management and risk management. It's more like you're applying the knowledge you've learned in sports, but now you're applying money management and risk management to be able to trade successfully. I believe that I've answered your question. Yes, it's going to be in the course, but not necessarily in the volume 2, but a separate entity on its own. Of course, in that separate entity, I'm going to delve into OKX, Binance, and Bitstamp, because these are the platforms you can actually trade futures and use margins. The next question, please. Someone asks if you can have my number and social media handle. You can contact me on Telegram and I will try and ask you for social media handles. Of course, Telegram is there. I have a YouTube channel, and then you can always send me email anytime you. I think I respond to email even more often than all these ones. Then you can also contact Francis if you have any questions. Francis can always get me. If you are finding it difficult to get me, you can easily get me through Francis. Yes, with time, okay, that is basically it. Do we have more questions?
Yes, everybody's cool.
Okay, good. So I think that is the end of this webinar. I will see you guys on Friday again, same time for the next webinar on support and resistance. I will try to get this recording out by Monday, hopefully. So see you then. Bye.
Bye. Thank you.
Thank you.
Thank you.